There is a fascinating disconnect right now
Yeah.
in how the market processes the artificial intelligence boom.
Oh, totally.
I mean, if you look at the consumer side, it's all like breathless announcements and dramatic software updates. You hear endless debates about the future of humanity.
Right, but if you look at the physical infrastructure, the actual hardware making this entire shift possible, the dashboard tells a completely different story.
It is remarkably quiet.
Yeah, it really is. The underlying mechanical foundation of this massive, technological leap is being built by companies that operate almost entirely under the radar of broader market sentiment.
Exactly.
And the numbers they are generating are staggering, yet the institutional reaction often barely registers a pulse.
Which brings us to our mission for you today. Welcome to this deep dive.
Glad to be here.
We have a highly specific goal for you. We are looking at a heavily jargon-packed snippet of tech market commentary that crossed our desks.
And it is dense.
Ugh, very dense. But our goal is to decode this text, because buried inside this dry insider financial shorthand is the actual blueprint for how the hardware side of the AI boom truly functions.
Right, and the piece we're examining presents this incredible paradox, which I know you wanted to get into.
Yeah, it describes a vital hardware asset that is up 11% in a single day as, quote, super boring.
Which is wild.
Right. And then it casually mentions that Wall Street's most sophisticated trading algorithms are currently being completely confused by explosive triple-digit AI growth.
So we are going to break down that paradox. By translating this incredibly dense institutional language into a clear picture, you start to realize that the most critical high-margin components of the global tech infrastructure are hiding in plain sight.
Hiding in plain sight and completely mispriced by automated systems.
Exactly.
Okay, let's unpack this, starting with the first company the source text mentions.
Yeah, let's look at Towa.
Right, a Japanese semiconductor equipment manufacturer. Ticker symbol 6315. The immediate framing is what caught my eye.
The boring part, right?
Yeah. The author notes that watching names like Towa is, quote, super boring, particularly because the Korean and Taiwanese markets, the KR and TW markets, are closed today.
Right?
But in the very same breath, they drop this line. They say it's, quote, only up roughly 11% so far.
Just casually throwing that out there.
I mean, calling an 11% jump boring is like complaining your daily commute is in a sports car that only goes 150 miles per hour.
That's a great way to put it.
Because for almost any traditional equity, an 11% gain in a single trading session is a massive outlier. It triggers circuit breakers.
Yeah, it's huge.
So why, in this specific corner of the semiconductor market, is an 11% jump dismissed as a snooze fest?
Well, the answer really lies in market liquidity and the expected behavior of institutional capital.
Okay, how so?
The text specifically highlights that the Korean and Taiwanese markets are offline. Those geographic hubs are the gravitational centers for global semiconductor trading.
Right, because you have Samsung and SK Hynix in Korea and TSMC in Taiwan.
Exactly. So when those markets are closed for a holiday, the overall trading volume across the entire Asian semiconductor sector just plummets.
I see.
Institutional traders expect a low-velocity environment. So seeing an 11% move on a day when the major players aren't even at the table, well, it feels anticlimactic to a quant or a high-frequency trader.
But beyond just the daily volume, the author compares Towa to companies like Hammond and Tower Semi.
Yes, and that comparison is key.
They characterize Towa as a, quote, steady compounder up throughout the duration of new memory cycles.
And that phrase, steady compounder, implies a level of predictability that traders usually hate.
Right, because traders want volatility. They want rapid movement.
Exactly. But a new memory cycle isn't some software patch you deploy overnight. We are talking about the industry-wide shift to high bandwidth memory, or HBM.
Which is the specialized stacked memory required for these massive AI server clusters, right?
You got it. And that shift requires a multi-year, incredibly capital-intensive industrial build-out.
So where does Towa fit into that build-out?
Towa builds the highly specialized equipment required for the molding process of these semiconductor chips.
Okay.
They aren't trying to invent a new consumer market. They are just systematically providing the specialized industrial tooling as the broader industry upgrades its architecture.
So the predictability is the point.
Exactly. When a fundamental architectural shift like the transition to HBM occurs, the equipment suppliers who dominate a specific node in the manufacturing process, they don't experience wild, speculative speculative swings based on consumer adoption.
Their order books simply fill up years in advance.
Right. They steadily and methodically stack cash as the foundries build out their fabrication plants. They compound their intrinsic value.
Which naturally leads to why their order books are so incredibly secure.
Yes, the source text gives a very specific reason for this predictability.
Right, and it revolves around the financial mechanics of their clients. The source states that Towa receives, quote, unavoidable Capex inflows from absolute industry behemoths.
Micron, SK Hynix, and Samsung.
Yeah, and the text attributes these unavoidable inflows directly to Towa's monopoly status.
Monopoly status is a strong term, but it fits here.
But, I mean, unavoidable Capex inflows is a striking phrase. Does this mean these tech giants are essentially forced to hand over money just to keep the lights on during a memory cycle?
Essentially, yes.
Is Towa basically acting like an unavoidable toll booth on the semiconductor highway?
That is a highly accurate way to visualize it.
Walk me through that.
Well, to understand the scale of this, you have to look at what capital expenditure, or Capex, entails in the context of advanced memory fabrication.
We're talking big numbers.
Massive. Capex for companies like Samsung, SK Hynix, and Micron runs into the tens of billions of dollars annually.
Wow.
They are locked in this existential arms race to produce higher yield, higher density memory chips.
And if they don't keep up?
If they delay their Capex cycles, they lose node leadership. And in the semiconductor space, losing node leadership is a death sentence.
Right, you just become obsolete.
Exactly. But they cannot simply source this highly complex manufacturing equipment from a diversified supply chain.
Because the technology is just too specific, right?
Yes. If we look at Towa's role, the chip molding process for something like high bandwidth memory is incredibly fragile.
You're stacking ultra-thin layers of silicon on top of each other.
Right, and the encapsulation and molding process requires a level of precision where the margin for error is essentially zero.
Zero margin for error.
None. So if you hold the defining patents and the proven physical architecture to execute that specific step better than anyone else in the world, you effectively hold a monopoly.
And that monopoly status alters the entire dynamic of corporate procurement.
Oh, completely.
Because Samsung and Micron, I mean, these are companies that traditionally possess immense leverage over their suppliers to drive down costs.
Right. They usually dictate the terms, but they have no leverage here.
Right.
They must upgrade their molding equipment to handle the new memory architectures, and Towa is the only viable destination for that equipment at scale.
So they pull up to the toll booth and pay the required fee.
Exactly. That is the fundamental mechanism behind the unavoidable nature of the inflows. Towa doesn't need to engage in aggressive sales tactics.
Or worry about competitive undercutting.
No, the cash flow is mandated by the physical requirements of the semiconductor upgrade cycle.
But I guess for a hedge fund manager looking for the thrill of a speculative breakout, this guaranteed monopolistic compounding is undeniably boring.
It's extremely boring to them.
Okay, so if an 11% monopolistic gain is considered boring, the author naturally pivots to where the actual volatility resides.
Yes, and the tonal shift in the source material here is quite revealing.
Very revealing. The author notes, quote, at least Enplas has some volatility.
Enplas, right.
And then they drop a data point that basically forces you to completely reevaluate the scale of the AI hardware boom.
Here's where it gets really interesting.
Exactly. The text highlights that Enplas grew their AI test segment by an astronomical 225% plus in operating profit year over year.
Just an incredible metric.
Let's pause on that. We just discussed how an 11% price movement was dismissed as boring. Now we are looking at a 225% operational profit growth in a hardware subsegment.
Right.
How does a company manage that kind of year-over-year leap? You don't achieve that just by selling a few more units?
No, you certainly do not. Growth at that scale indicates a structural bottleneck in the supply chain.
Okay, explain that.
To grasp why Enplas is experiencing this violent acceleration, we need to examine the function of an AI test segment.
What are they actually testing?
When foundries manufacture the ultra-advanced logic chips and GPUs required for training large language models, those chips represent thousands of dollars in individual unit value.
You're super expensive.
Very. And before they are packaged and deployed into server racks, they must undergo rigorous, high-stress testing.
Burn-in testing, right.
Exactly. Burn-in testing ensures they won't fail under the immense thermal and computational loads of a data center.
Because if a high-end AI chip fails after it has been integrated into a massive server cluster, I mean, the replacement costs and the system downtime are catastrophic.
Catastrophic. It's a huge disruption.
So the testing phase isn't just some quality assurance checkbox. It is a critical safeguard for billions of dollars of downstream infrastructure.
Precisely. And Enplas designs and manufactures the specialized burn-in sockets and testing equipment that physically interface with these highly complex chips.
And as chip architectures become increasingly dense, moving to smaller nanometer processes and more complex 3D packaging, the physical demands placed on those testing sockets increase exponentially.
Right. They have to handle extreme heat and maintain perfect electrical conductivity across thousands of microscopic contact points.
So it's not a simple piece of plastic.
Not at all. For a long time, the testing equipment market grew at a moderate pace alongside the broader semiconductor industry.
Sure, steady growth.
But the advent of generative AI caused an unprecedented vertical spike in demand for the highest tier silicon.
All right, the industry hit this crazy inflection point. Suddenly, every major hyperscaler, Microsoft, Google, Meta, they demanded hundreds of thousands of the most advanced chips simultaneously.
Yes,
And all those chips had to pass through the testing bottleneck.
exactly. And when an exponential demand shock hits a specialized bottleneck, the supplier's pricing power skyrockets.
Which explains the 225% jump.
Yes. A 225% increase in operating profit demonstrates that Enplas isn't just scaling production, they are capturing significantly higher margins.
Their efficiency, their pricing leverage, and their scale all multiplied at the exact same time.
And that creates the volatility the author was searching for.
Because in institutional finance, volatility is simply the velocity of price movement.
Right. When a high-margin segment of your business triples in profitability, it exerts massive, unpredictable upward pressure on the underlying valuation model.
Which stands in stark contrast to the steady, predictable Capex cycles of a company like Towa.
Exactly. It's a totally different beast.
But the source text pushes beyond just these abstract profit percentages. It highlights the specific physical hardware driving this inflection point.
Which is crucial because the cloud isn't just software.
Right. The cloud, as we know, is heavily physical. It requires actual material infrastructure to move data.
Miles and miles of it.
And the text provides a crucial update on this front, quoting, "Mass production of lenses for 1.6T optical transceivers has launched."
That single sentence is arguably the most significant technological catalyst in the entire commentary snippet.
Okay, let's translate the mechanics of what a 1.6T optical transceiver actually does, because it sounds highly theoretical, but it is fundamentally about industrial data plumbing.
Industrial data plumbing is a perfect way to describe it.
So 1.6T refers to a data transfer rate of 1.6 terabits per second, right?
Yes, massive throughput.
Because modern AI server clusters require data to move at a scale and speed where traditional copper wiring becomes a literal physical liability.
Absolutely. If you try to push that volume of data through copper, the electrical resistance generates an unmanageable amount of heat.
Right, things would literally melt.
Pretty much. And the signal integrity degrades rapidly over short distances. So the architecture has to shift to silicon photonics.
Meaning you have to use light.
Yes. These transceivers are essentially high-pressure data valves shooting lasers across server farms to connect the GPUs.
Lasers across server farms.
Yeah.
That's wild. And Enplas is manufacturing the highly specialized microscopic plastic lenses that focus and align those lasers.
And the engineering challenge here cannot be overstated.
How difficult is it?
We are talking about molding optical-grade plastics with sub-micron precision.
Wow.
These lenses must maintain perfect optical clarity and structural integrity while operating continuously in the extreme thermal environment of a high-density AI data center.
Because any warping or degradation means data packet loss.
Exactly, and data packet loss basically cripples the AI training model. You can't have it.
Which makes the phrase, mass production has launched, the real trigger here.
Oh, complete.
Producing a perfect lens in a controlled laboratory environment is a significant engineering feat on its own.
Sure.
But reliably mass-producing millions of these microscopic components with absolute zero margin for error. That crosses the threshold from a science project into a massive financial catalyst.
The transition from research and development to mass production alters the fundamental economics of the product line.
How does that shift work financially?
Well, during the R&D phase, developing an optical transceiver lens is a massive cost center.
Right, you're just burning money.
Exactly. It requires heavy capital investment in tooling and materials engineering, which weighs down the balance sheet.
But then mass production hits.
Right. The moment mass production launches, Those fixed costs begin to amortize across massive purchase orders from global data centers.
Ah, I see.
This transition is the physical engine behind that 225% profit explosion we talked about.
It's the exact moment when the abstract requirement for faster data transfer crystallizes into severe, high-margin cash flow.
Yes, beautifully said.
Which brings us to the glaring contradiction that makes this entire source text so fascinating to me.
The blind spot.
Right. So what does this all mean? If we follow the logic, Enplas has a structural bottleneck advantage in AI testing, resulting in a 225% profit jump.
Check.
They have successfully crossed the mass production threshold for the critical optical plumbing required for the next generation of data centers.
Check.
Given those two massive catalysts, why isn't this asset completely dominating market headlines?
Or, it's a great question.
I mean, if the market is a perfectly efficient pricing mechanism, this data should already be priced in, and the stock should be experiencing overwhelming institutional demand. But there is still volatility.
Well, the assumption of a perfectly efficient market is exactly where many automated trading strategies fail.
Really?
Yeah. The market is frequently blind to structural shifts if the data isn't formatted in a way that aligns with standard screening parameters.
And the text points directly to the mechanics of this inefficiency.
It does.
It states, quote, "Pretty sure they're sandbagging, plus have legacy drag confusing algorithms regarding AI segment acceleration."
Such a brilliant sentence.
It's a fantastic look into the friction between corporate strategy and algorithmic analysis.
Let's break that down.
Yeah, how exactly does a company sandbag this level of success? And more importantly, the mathematical mechanics. How do Wall Street's quantitative algorithms get confused by it?
Okay, so the concept of sandbagging is deeply ingrained in corporate governance, particularly in legacy manufacturing sectors.
Okay.
Management deliberately issues overly conservative forward guidance.
Basically, they lie low.
Right. They intentionally downplay their internal projections for these high-growth segments to ensure they can consistently beat Wall Street estimates quarter after quarter.
The classic under-promise and over-deliver.
Exactly. By muting expectations, they prevent the stock from running too hot based on speculative fervor, preferring a controlled, easily manageable narrative.
So they intentionally lower the bar, so even a baseline operational performance looks like a strategic victory during an earnings call.
Precisely.
But sandbagging is a human management decision. The far more systemic issue here seems to be the legacy drag.
Yes, legacy drag is what actually breaks the algorithmic models.
How so? I mean, if I am a quantitative trading algorithm, I am ingesting massive data sets and analyzing SEC filings at the speed of light. How does a highly sophisticated multi-factor model completely miss a 225% spike in operating profit?
It misses it because algorithms are inherently dependent on the weighting of top-line aggregates.
Okay, unpack that for me.
Enplas is a mature company with a long operational history. They possess established traditional divisions, what the market terms legacy business.
Like what?
This might include automotive plastics, standard LED components, or basic electronics manufacturing.
Okay, the older stuff.
Right. And these divisions generate substantial, consistent revenue, but they exhibit very low or sometimes even negative growth rates.
So if I am a quant screener scanning the global market for high-growth AI exposure, my parameters are heavily weighted toward overall revenue acceleration and top-line margin expansion.
Precisely. Now imagine the hypergrowth AI test segment and the new optical transceiver division only represent, say, 10 or 15% of Enplas's total overall revenue.
Oh, I see where this is going.
Right. That 225% growth metric is mathematically diluted by the massive weight of the legacy divisions.
Because it's only a fraction of the whole pie.
Yes. If the legacy business is flat, the overall corporate top-line growth might only register as a 2 or 3% increase.
Wow.
The algorithm ingests that aggregated data, categorizes the asset as a stagnant, low-growth legacy manufacturer, and immediately filters it out of the investment universe.
It is literally a mathematical cloaking device.
That's exactly what it is.
The quantitative screeners are literally incapable of seeing the hyperacceleration happening deep inside the subsegments because they are blinded by the sum of the parts average.
It is a profound structural inefficiency.
So human analysts, like the author of this text we're reading, they're the ones manually digging into the segmental breakdowns.
Yes, they bypass the top-line screeners and locate the hidden alpha.
They see the underlying truth of the optical mass production, while the billion-dollar trading bots just walk right past it.
It really demonstrates that structural edge in modern markets doesn't necessarily come from having faster data feeds.
Where does it come from?
It comes from understanding how legacy corporate structures distort the data feeds that everyone else relies on.
Right.
The algorithms demand clean, pure play narratives. When a generational technological leap is housed inside a traditional manufacturing shell, the automated systems simply fail to process the reality of the situation.
This has been an incredibly revealing journey through just a few seemingly dry sentences of market commentary.
It's amazing what's buried in the text.
Truly. We began by analyzing the illusion of the boring market, looking at Towa, a company where an 11% daily gain is dismissed simply because they have secured an unavoidable monopolistic hold over the massive capital expenditures required for the new high-bandwidth memory cycle.
Right, they represent the slow, heavily capitalized bedrock of the hardware transition.
An essential foundation that compounds value quietly while the rest of the market looks for software breakouts.
Exactly.
And from that steady foundation, we explored the hidden volatility of Enplas, a company that has positioned itself at the absolute bottleneck of AI deployment.
Testing high-end logic chips.
Right, and mass-producing the microscopic silicon photonics required to keep data centers from melting down.
And generating triple-digit profit acceleration.
Yet, they remain obscured from institutional capital due to deliberate corporate sandbagging and a legacy business structure that mathematically blinds algorithmic screeners.
It forces you to realize that the most critical infrastructure of the future is rarely broadcast on the front page.
No, it's not.
It is buried in the operational mechanics and the segmental footnotes of companies that automated models overlook.
Which leaves you, the listener, with a rather profound question to consider as we conclude today's deep dive.
Yes, I want you to consider the implications of this algorithmic blind spot.
Go ahead.
If highly sophisticated, capital-intensive quantitative models can be completely misdirected by the simple mathematics of legacy drag, if they can fail to recognize a 225% explosion in critical AI hardware profitability just because it is housed within an older corporate structure, what other world-changing innovations are currently hiding in plain sight?
That's a great question.
What other massive technological leaps are out there right now, quietly passing the threshold into mass production, masked entirely by the boring traditional business models of the companies developing them?
It is a powerful reminder that sometimes the most explosive growth isn't signaling its presence with alarms.
No, it's just quietly waiting for someone to look past the top-line averages.
Thank you for joining us on this deep dive into the hidden mechanics of the tech market. Keep digging into the footnotes, and we will catch you on the next one.